All right, this week we're answering the following question. I hear pharmacists talking about doing a backdoor Roth IRA. What exactly is a backdoor Roth IRA, and can I do this myself? Tim Baker, what are your thoughts?
Yeah, Tim, as you know, this is probably one of my favorite topics to talk about because I think it's sarcastically, I think it's something that's very like oversimplified and often is done incorrectly. So what I typically do when we speak on this topic publicly is I kind of show the workflow of, can I make a backdoor Roth contribution? And it's basically a series of questions about what's your income, are you married, are you covered by a plan, do you have pre-tax, all that stuff, which is again things that you have to consider as you're going through this. So that's the complicated version. The broad strokes simplified version, which everybody I think zeroes in on because it's like, oh, you just do this and then you do that and then you're done. So the big reason that we look at backdoor is, especially for people listening to this, pharmacists, they make too much money to put contributions into their Roth directly. So one of the things with Roth eligibility is like if you're single in 2024, your ability to contribute to your Roth starts to phase out at $146,000, and then the door is completely shut for you to make any contribution into your Roth at $161,000. So this is your AGI, your adjusted gross income. If you're married filed jointly, that phase out goes from 230 to 240, right? So there's a lot of people that are pharmacists that are listening to this as a couple. They're like, hey, we make more than that. So it limits your ability to put money into your Roth at all. So you're kind of, up a creek. For a traditional IRA, so think this is pre-tax, Roth is after tax. If you have earned income, anybody can put money into a traditional IRA. However, what makes a traditional special, what makes it traditional essentially is that you get a tax deduction for that. So what I mean by that, if you make $50,000 and you put $7,000 into your traditional IRA, you get a pre-tax deduction. So the IRS looks at you as if you made $43,000, right? The nice thing about the traditional IRA is that anybody can put money into it, but you don't necessarily get the deduction. So if you're single, once you start making, 77 to 87,000, once you make $87,001, you can put money into that, but you can't get that pre-tax deduction. If you're married filing jointly, it's 123 to 143. So that's the big thing here is that most people, they can put money into the traditional IRA, but they can't get the deduction, which kind of makes it not a smart move. But then you're also in the spot of like, if you make too much money to put money directly into your Roth IRA. So what do you do? And that's where the backdoor Roth conversion, basically pops up. So essentially, the two big things that you do to do a backdoor Roth is you contribute to that traditional IRA. You do a non-deductible contribution to that IRA, and then you basically convert or transfer those funds into a Roth IRA. So there's lots of controversies and things to think about. A lot of people look at this as like a legal loophole. Congress has not necessarily in different, versions of the tax code, they haven't said, hey, this is a thing that's allowed or not allowed. They haven't necessarily addressed it, but that's kind of what you do. So the big things, the big things that we have to really account for here, Tim, is basically two rules to consider: the aggregation rule and the step transaction doctrine, or step transaction rule. So in the step transaction rule, basically what we are talking about is the timing of when you basically put the money into the traditional and then you move it over into the Roth. So many people say that if you kind of do those in succession, the IRS says, hey, even though we know this is a loophole, you're exploiting a loophole and we're going to disallow it.
If it's too close.
If it's too close, right? So these actions should be interdependent, meaning each step is meaningless on its own and exists solely to achieve a specific tax benefit. It's preordained, meaning there's a clear plan to complete all these steps to achieve a tax result. and it's done in quick succession. So the steps are completed so quickly that they appear as a single integrated transaction. So let's say I do this, I make a non-deductible contribution to my traditional, I do that, and then 5 minutes later I move it to the Roth IRA. The IRS is saying, "Hey, you're doing this to game the system. We're going to disallow that."
So much gray area, right? It reminds me of when the IRS defines deductible business expenses as those that are ordinary and essential to the conduct of business. Okay. I mean, there's a lot of subjectivity in there. So
Yep.
what I'm hearing is like it can't be bang bang, but then that inserts the question of, well, what defines it not being bang bang?
Right. And I'm not trying to make like enemies with the IRS, but to me it's so silly. Just like and a lot of IRS ruling, it even with a ruling, it's specifics. Like if they were to come out with an opinion
Right.
on, like they would say that would be like, let's say I did this and they disallowed it from I'm talking about my personal, and I said, hey, I don't like this, and I challenge it, and they issue a ruling. They basically, what the IRS is saying, this is for Tim Baker's specific case. So you couldn't look at that
Yeah.
and say like, oh, I can do this too. Now that's what people do, but they're not even, they talk about specific cases. So I know advisors that do this for their clients. They put money into their account. They say, hey client, we're going to put money into your traditional. And then that day they move it over and like, we're good. I don't know of any cases where they've actually disallowed it, but we're taught, even the way that we're supposed to talk about this, like the
Right.
name itself is a kind of an indication that you're trying to do this preordained. So so the most people, I think, that are doing it somewhat conservatively, they'll offer like a buffer of 30 days where it sits there for 30 days or even a year. That's the most conservative approach. And again, a little bit this is like eye rolling, because it's like, just say it's good or not, right?
Right.
Just,
Right.
just either close the loop or say people can do this.
Yeah.
So that's the step transaction rule. The other thing that you have to take into account, which I think again is often glossed over, is the aggregation rule. So the aggregation rule basically is it what you have to do before you can basically say, okay, I'm going to put $7,000 into my traditional and then move it over into the backdoor without any like taxable event. You create a taxable event if you have balances in a traditional IRA, a SEP IRA, or a simple IRA, or any other like pre-tax. We're not talking about a 401k,
Yep.
but like those IRAs that are hanging out there. So what the IRS says is like, hey, if you have balances here, it is a taxable event. The way this works is, let's pretend, Tim, that I have $90,000 in my rollover IRA, my traditional IRA. So I worked for a company. I worked for CVS. I was there for a couple of years. I'm like, all right, I'm moving away. I'm moving on from CVS. I'm going to go work for a hospital in Columbus. I roll over that 401k, that Vanguard 401k that I had with CVS, and now it's at a account at Fidelity or Vanguard or some custodian as a rollover IRA. Those are pre-tax dollars. Let's pretend that I'm like, all right, I hear people talk about Roth conversions, backdoor conversions, that type of thing. I want to do that. So for 2024, I can do $7,000 every year. Now, in my mind, I'm thinking, hey, I can put $7,000 into my traditional non-deductible and then move it over, and that's a non-taxable event. That's not the case because I have
You already
$90,000
have a
in my
balance.
rollover. So you have to go through kind of this calculation. So what you do, you had to determine what your non-taxable percentage of your of this conversion looks like. So you essentially take the after-tax contributions, which is the $7,000, and you divide that by the total IRA balance. So in this case, it's the $90,000 plus the $7,000 that I'm putting in. So $97,000. So $7,000 divided by 97,000 gives me 7.22%. So that's essentially the non-taxable portion of my conversion. So if I multiply that by $7,000, Tim, that's essentially $505. So if I then take 7,000, I subtract that 505, that means the taxable portion of my conversion is 6,495. So that's what gets taxed. And then the 505 escapes tax. So, and if we stack this up, so if I look at this and I have scenario one that I just talked through, where I think I'm free and clear,
right?
I'm actually adding 6495 to my 1040. Actually, you report this on
Yep.
form 8606. But if I assume I'm in a 25% tax bracket, if I'm reporting 6495 times 25%, I'm paying tax on $1,624. If you compare that to like I don't have any money in my pre-tax account, it's basically $0,
Right.
right? And a lot of people think like, is this double taxation? It's not double taxation. They're forcing you to pay tax on some of those pre-tax dollars that you've already accumulated.
Already there. Yep.
So it's not double taxation. They're just saying, hey, this is not. And so you're kind of just doing a Roth conversion.
Mm-hmm.
So at any point in my life, I could say, hey, I have 90,000. If we set aside the backdoor conversation, you could say, hey, I have $90,000, and let's say I get laid off, and I'm basically making zero money, but maybe I have access to cash, and you'll see why in a second. I could say I have $90,000 that is hanging out there pre-tax. A strategy that I could do is I can convert all of that 90,000 to a Roth and just pay the tax on the 90,000 where my marginal bracket is really, really low.
Right.
So, and I have to have the cash to be able to do that, to pay the taxes for that, but you can do that anytime. So what we're doing in this conversion where we have pre-tax dollars is that we're just being forced to pay that amount. So that's where I think people they get it wrong, is because they think that it's just put money in your account, transfer it over without all the other stuff. And again, I'm not as worried about the step transaction rule. It's the
It's the
aggregation rule where
aggregation.
people get
Mm-hmm.
get tripped up, and can go awry. So that's the that is essentially. And I will say that for people, it's kind of like what we talk about. People are like, oh, like I have this Robinhood account where I have $10,000, but then I have no emergency fund.
Mm-hmm.
I'm not, I'm not even getting my match in my 401k. I think a lot of people, I would say, exhaust the other buckets before you look at a back door. So make sure that you're maxing out your 401k. Make sure you're maxing out your HSA if that's available to you. Do you have money in a brokerage account? If you're going to retire early or some other things like that would be something. And then look at it. I do think it's valuable to be able to open up that bucket. But I think a lot of people will, it's kind of like doing something for the sake of tax. Well, that's not consistent with your financial plan. Make sure you're going through the other steps first before you look at this, because it can be complicated. I will mention that one of the ways around the pre-tax, the aggregation rule is to move funds into your 401k.
Mm-hmm.
So you could say, hey, before I do that before I do this conversion, I'll move that $90,000 into my 401k, and then you're free and clear.
Yeah, really good overview. And I think the point you made at the end there of being careful about not making a financial move just for it being a tax move, right? Or I think this is one where we see like, hey, everyone's talking about doing backdoor Roth, so like I need to do it. And there's obviously a lot more work to be done to figure out where does this even fit in with everything else that's going on. And I'm going to sound old saying this, but it's true. This to me is the danger of like 60-second or less like social financial advice and planning that's out there on various channels, right?
Yeah, or
Because
water cooler talk, if that still happens, where it's like,
yeah,
yeah,
yeah, and I think that's your point is spot on. That I think a lot of people are familiar with. They hear the term. I think there's a pretty good understanding about it. They might read something or watch a video real quick, and it's like, oh, okay, step one, I put it into make a non-deductible contribution to my traditional, and then I've got to move it. Not thinking about the step transaction rule, or to a greater degree, the aggregation rule and some of the calculations that need to be done. And the bigger question behind all of that, to me, is like, where does this even fit with everything else that is going on? So we're
yep,
making an assumption that this is where we need to be putting our dollars. And maybe that's true, maybe it's not true. And that to me is the art of the financial plan of, let's look at every piece of the puzzle. And before we take action on this one piece of the puzzle, what else is going on in the financial plan?
yeah. I mean, another example that I give you is like, oh, like I'm working towards PSLF, but like my
Yes.
parents or my colleagues say I need to max out my Roth. I'm like, no, those things are not compatible. They're not
Mm-hmm.
compatible, right? And I think it's that, you know, it goes back to the answer. It depends. Like, it depends on your situation. And I think a lot of people, I hear this a lot, like, I get advice from parents, or my colleague that's really savvy with money, savvy in quotation marks, is telling me to do this or that. I'm like, it does require personalization, customization in my, again, we're biased on this because this is what we do, but there's a lot of that misinformation, especially with, like, social media and things like that, of like, this does not suit you. And this is one of those things. And I think the other thing is, like, even if you do this, even if you do, a non-deductible IRA contribution, and like, even to like manage that, because you're talking about an account that has both pre-tax and then non-deductible contributions that you're supposed to be tracking through Form 8606 every year. Like, it's a nightmare. Like, I'm like, don't do it. So it's one, I think it takes a little bit of TLC and attention, and that's why I kind of like, I think people think that I'm like, the old man shaking my cane or yelling at the clouds or whatever. But like, it's just often something that it's like, we jump to this conclusion. I'm like, why are we even doing this? So,
Great stuff. As Tim was talking, I went and pulled the IRS's table for amount of Roth contributions that you can make for 2024 based on income and tax filing status. We'll link to that in the show notes. So I know he threw some of those numbers out there, but if you want to go reference those as well. And as we wrap up this week's episode, just a reminder, if you have a topic that you would like us to cover on a future episode, or a question that you'd like us to answer, send us an email, info@yourfinancialpharmacist.com, or you can send us a voice memo by visiting yourfinancialpharmacist.com/ask. An important reminder that the content in this podcast is for informational purposes only, is not intended to provide, and should not be relied on for investment or any other advice. Information in the podcast and corresponding material should not be construed as a solicitation to offer or buy, sell any investment or related financial product. For more information on this, you can visit yourfinancialpharmacist.com/disclaimer. Thanks so much for listening, and have a great rest of your week.